Well, good morning and good afternoon, everyone. It's my pleasure to welcome you all to this presentation and to share with you what we have learned about equitable financing solutions in Waterloo Region, in the hopes that it will be helpful to other communities across Canada. Next slide. My name is Mary Jane Patterson, and I'm the Executive Director of Reep Green Solutions. Reep is an environmental charity serving Waterloo Region in Ontario and the neighboring watershed, with a focus on helping people live sustainably. And I'll say a little more about that in a minute. I'll be starting us off today with a little background on how this research came about. And then I'll turn it over to Yasmin Abraham, who conducted this research with her team on our behalf. Yasmin is co-founder of Kambo Energy Group and the visionary behind Empower Me, Canada's only energy and climate-focused program designed for and delivered by members of underserved communities. Under Yasmin's leadership, Kambo has become a leader and advocate for the inclusion of lower-income families in climate policies, specifically advocating for supports for families experiencing energy poverty. Kambo's Community Power Division is dedicated exclusively to reducing energy poverty and improving housing conditions in Indigenous communities. Yasmin will then turn it over to our final speaker, Stephanie Drozda. Stephanie is a program specialist with Alberta Ecotrust Foundation, an environmental charity based in Alberta. Alberta Ecotrust is part of the Low Carbon Cities Canada network, working to accelerate urban climate action through their Climate Innovation Fund. Stephanie will provide context on Alberta's energy efficiency program landscape and outline efforts to launch an energy poverty-focused home upgrades program in Calgary and Edmonton in partnership with Kambo Energy Group. Throughout our presentation, if you have any questions, please use the Q&A here in the Zoom to include your questions. And we hope to have time at the end of the presentation to address them and possibly even along the way. So we'd like to start by acknowledging that my colleague Lisa Trong and I and Reep Green Solutions are located on the traditional territory of Indigenous peoples, including the Haudenosaunee, Anishinaabe, and Neutral peoples. Yasmin, Stephanie, and her colleague Mike Melross are joining from Alberta, across the traditional territories of Cree, Blackfoot, Métis, Nakota Sioux, Iroquois, Dene, and Ojibwe Saulteaux Anishinaabe nations, lands that are now known as part of Treaties 6, 7, and 8, and homelands of the Métis. We recognize the enduring presence of the Indigenous people with whom we share these lands today, their achievements and their contributions to our community. We value their traditional knowledge about how to live sustainably on this land that we share and will leave for our future generations. All of our organizations are committed to engaging in the necessary learning, building of relationships, and action required to work towards reconciliation between Indigenous and non-Indigenous peoples and our communities. Well, I'll say a little now about Reep Green Solutions and how this all came about. We work mostly at the household level, helping people take action on climate change through programs such as home energy evaluations and water conservation visits. We also support our community in adapting to the changing climate and preventing floods by helping to create healthier yards that include rain gardens, native trees, and pollinator species. Next slide, yes, thank you. Reep also co-leads the climate action plan for our community, along with our colleagues at Sustainable Waterloo Region. Transform WR is our long-term climate action strategy to transition to a more equitable, prosperous, and resilient low-carbon community. And the next slide. Our greenhouse gas inventory shows that homes make up 18% of emissions in Waterloo Region. With a goal of reducing our emissions by 80% by 2050, we identified a number of strategies to address the residential sector, And we've highlighted two of them here: decarbonizing the heating and cooling of our homes, and then woven through all of this work, the goal of increasing equity while reducing emissions. So we received funding from the FCM's Community Efficiency Financing Program to design a 4-year home energy retrofit program, including loans for energy upgrades. Our working group was made up of 4 municipalities, 5 energy utilities, our local community college, and WR Community Energy, which spearheads energy investments in the region. We wanted to make sure to embed equity within the design of the program and pay particular attention to the impact of loans on lower income households. I think I'm on the next slide, Yasmin.
Oh, I'm sorry.
Oh no, wait, this is the right one. You can see that we were fortunate to work with Dunsky on the design of the overall program and with Kambo on bringing equity into that design. CUSP provided a deeper dive into their energypoverty.ca platform to help us understand demographics in our community in more detail. And that work was separately funded by the KW Community Foundation. So here is our simple diagram to reflect the 3 main components of our energy program design: financing, community engagement, and a one-stop window to make it easy for people to participate. And you can see that surrounding all of that is the challenge that we brought to Kambo. Help us embed equity in all of these components and answer the question, should households on low to moderate incomes be participating in these loans? And if so, how? So I'm going to turn it over to Yasmin now to take it from here.
Thank you, MJ. Thank you, everybody. As MJ mentioned, I am Yasmin Abraham, co-founder of the Kambo Energy Group. We design and deliver equity-focused energy and climate programs through our 2 divisions: Empower Me, which works with immigrants, newcomers, and households facing energy poverty, and Community Power, who works alongside Indigenous nations to support housing, climate, and energy needs. So as MJ described, the project really was to embed an equity lens in the anticipated financing program that's going to be offered in the Waterloo region. How did we do this? So we really started with a combination of the interviews with frontline staff, with community groups. We talked to experts in the field and integrated our own experience to develop an overview of the risks, the barriers, and the recommendations. And we're so pleased to share those with everybody here today. These are some of the groups that we worked with. We had the privilege of working with a number of groups in the region who all work with lower income households. Lots of folks working in housing and job creation and supporting these households and clients. And if anybody here has had the pleasure of talking to any community groups through outreach, you'll know that this is certainly, one of our favorite parts of the job. These people really do understand the pulse of the community and what the lived experience is like. We delivered interviews and focus groups with each of these groups. They were very generous in their time, and we're so grateful for that. And we analyzed the data and collated that data for the report for Reep Green Solutions to provide to FCM with an overview of the challenges. So here's an overview of the things that we heard, just very high level, but certainly challenges across the board. And unfortunately, nothing really too surprising from the things that we heard. People are really struggling with their basic needs. Folks have low incomes and high poverty levels. The cost of living is through the roof and has increased since we even did this work. Inflation is affecting food, housing, and transport costs the most, and these families already are spending a disproportionate amount of their income on these basic needs. Folks typically have really low-paying jobs, and they're facing racism, discrimination, and social exclusion that was exacerbated even more by the pandemic. Social supports were cut off during the pandemic. And food security was a big one. Almost every single group talked to us about food insecurity and the fact that a lot of their clients are jumping on buses and transit and going quite far away from their homes to go to food banks and bring food home for their families. Mental health and isolation, I think this is something that we all dealt with during the pandemic, but certainly for this group, it was quite exacerbated. And language barriers. You know, a lot of the groups that a lot of the clients these groups work with are immigrants and newcomers, and a lot of folks had a lot of language barriers to access the services that they provide. So we collated all these interviews and all of this information, spoke with stakeholders across the region and the working group to identify the main barriers to participating in the financing program. So all of the reasons that a lower income family could not apply for a financing program. And I will be sharing these with you now. So the first barrier, I think, is probably not a surprise. Cash is king. These families really have very little ability to absorb changes in short-term cash flow. Any program, whether it's a financing program, a rebate program, even a lower income energy efficiency program that requires an upfront cash disbursement, is going to be a barrier for some of these households. The second barrier we found is really that debt is not considered to be a financial tool. It's certainly a financial privilege to take on debt to further your financial situation. In these groups and in these households, debt is viewed as something to avoid and only to be used in emergency circumstances to keep heads above water. The third one is around renters. And this, you know, I think we all are probably familiar with renters and the challenges of including them in programs. Programs are out of reach for these renters who cannot and would not upgrade their homes, and landlords aren't incentivized to invest in homes they don't live in. For the barriers, offers are often seen as too good to be true. Many households simply don't trust and are wary of government programs and offers that they think are too good to be true. This is a challenge across all programs, I think, in our country. And we certainly saw this with the pandemic. We saw a lot of immigrants and newcomers really hesitant to get their vaccine because there was fear that their immigration status would be shared across government departments. The concerns about sharing this information across governments is really a barrier for folks, and it really prevents them from uptaking programming. Processes are not designed for everyone. They're typically not designed for the literacy, awareness, and access needs of these groups. Often materials are only in English, and they often assume a level of understanding of how home structure impacts energy costs. So how, why does the region want me to upgrade my home with insulation? What is the link between my home's insulation to my energy costs, to GHG and climate goals? That link between those pieces is missing for a lot of folks. And forms and programs are often online only, which can be a real barrier for a lot of clients. Homes that are in the poorest quality often don't qualify for the financing. So ironically, a lot of these homes, they might need mold remediation, electrical work, drywall to get them to the point where you can do full building envelope upgrades and take part in financing programs. Some financing programs don't allow those upgrades to be included in financing. And so that can really be a barrier if those program processes are in place. Risks. So we talked a little bit about the barriers for lower income households to participate. Now I want to talk a little bit about the risks that we determined of if these households do participate, what are some of the challenges for them that maybe some of the higher earning households don't have. So the big one is the risk of being unable to afford the loans. This is really the challenge for these households. Households that participate in a program, but who can't afford the payments, they're going to struggle. And these households that struggle to make the loan payments will undertake a series of decisions to prevent late or no payments. These might include falling behind on other bills, trade-offs of household essentials such as food, childcare, extracurriculars, and other financial services like payday loans to try and catch up. We heard time and time again that being late or defaulting on loans is the absolute last option for families. This is especially true if loans are tied to properties. They're not going to risk losing their home. Community groups we talked to really stressed the link between housing and child custody. A lot of these clients are dealing with child custody cases, and for those families, losing your home or being at risk of losing your home can have a real impact on losing your kids and your child custody. So I'm sure, you know, any of the parents who are on this call today can think about all the decisions we would likely make financially before we were put that risk. Households that don't make payments and that cannot make payments, they're going to need to absorb the impact and the penalty of late payments or defaults. And depending on the final program design, these can range from increased fees, lower credit ratings, collections agencies, power shutoffs, property liens, etc. These cascading impacts can be really negative. So we need to make sure that the participants in our programs can afford the loans we give them. Now, our industry and sector often looks at default rates as an indicator of whether we are appropriately loaning money. Default rates measure the risk for the lender. So how safe is my money? If I'm going to lend this money to these households, how likely am I going to get this money back? How likely are people likely to repay me? And they're pretty good for these programs. The challenge is that default rates do not offer a measure of the negative impact to the household. It does not give us a sense of what are those negative decisions that the household is making, how many people are going to payday loans to pay off this debt as part of the program. So we do need to consider additional KPIs that offer a household-centric view. The second risk for lower income households participating in financing programming is around unrealized energy bill savings. So many financing programs will use the promise of savings as a way to build a positive business case for the resident. Save $80 a month, your loan payment is $60 a month, it's net positive for the household, which sounds great. The challenge here is that the homeowner is taking all the risk for the savings. It's not the contractor and it's not the lender. For a higher earning income household, if the savings aren't realized, let's say folks only get $70 a month in savings, it's not such a big impact. It's not such a big deal to absorb. But lower income families have little ability to absorb these additional or unexpected costs. And if these savings aren't realized and they've been used to justify the monthly payments, this can really be a challenge. With little ability to absorb additional or unexpected costs, the promise of energy bill savings covering a portion of loan repayments is a critical risk factor for lower income households. The third risk factor is around the impact to debt to service ratio. So debt to service ratio is a financial metric used by lenders to determine whether or not to extend credit. So if you need a car loan, if you want to remodel your kitchen, if you suddenly need to fix your roof, lenders will look at the total debt divided by your total income to determine what your debt to service ratio is. If you want to get a mortgage, lenders typically want this to be under 43%. So the higher your income is, the more debt you can afford to take on. The lower your income is, the lower amount of debt you can afford. A lower income household, say, might be able to afford $45,000 of debt, whereas a higher earning household could service maybe $145,000. So for a lower income household, participation in a financing program will account for a greater proportion of the household's available debt they can service than a higher income family. This generally leads to a higher debt service ratio for these households versus higher earning households. So if a family is financing a loan of $35,000, this takes up a much greater proportion of that $45,000 that's available for a low income household versus the $145,000 that a higher earning household can borrow. The impact of this is that it results in a reduced ability to take on additional debt for unexpected expenses in the future. So if cars break down, if something happens to a pet, if there's an unexpected expense, the lower income household has a challenge or lower ability to take on additional debt to address those needs. This could result in higher interest rates for future financial debts. The fourth risk, and finally, the risk for households to take on more debt than they really need, or to take on upgrades that are lower priority or don't achieve households' goals, which might be affordability or comfort or greenhouse gas savings. We don't want to put households in more debt than they need to be. So it's important to consider these risks when we design programs, because if we don't, we might inadvertently loan funds to households who cannot afford it. Participation in the program might leave participants in a worse financial situation than before, and default rates are not an indicator of this. The impact of this to the participant is an impact to their credit, stress and impact of creditors, risk of mortgage, loss of property, and the impact to our stakeholders is there's a real reputation and political risk here. You know, all it takes is one story in the media to really put a black mark on this industry across our sector. So let's talk about recommendations, because financing programs are an important tool to achieve our goals. And with a bit of strong program design, we can ensure we're protecting lower income households while supporting residents who are appropriate program participants. So we had 4 areas of recommendations for Reep and the stakeholder group. The first one is around consumer protections. We want to make sure that the program only accepts participants who can afford the loans. We want to make sure that all our stakeholders are feeling really good about and confident that every participant should be able to repay the loan. The second one is around clearly defined default and late payment processes. We want to ensure that all stakeholders are aware early in the process and are comfortable with the late and non-payment process in program design. And the third one is around, we want to be able to consider terms that reduce the financial risk for participants. And of course, we want to ensure the program is equitable and we say what we're going to, and we do what we say we're going to do by embedding equity-based KPIs in the program. So let's get into some of the specific recommendations we offered to Reep and the stakeholder group. The first one was around the consumer protection. So we want to make sure that we're clearly defining the target market. Who is this program appropriate for and who is it not appropriate for? We want to ensure the underwriting criteria that's used to accept people into the program reflect this. Credit scores are often used as a consumer protection strategy, but these offer a sense of the likelihood of repayment. They don't offer a sense of affordability. We recommended that Reep consider a total debt service ratio for participants to ensure they have the ability to repay their loans. Once we have processes to be confident that all participants can afford the loan, we also want to think about ways to reduce the financial risk. The program could offer extra levels of support to mitigate tight cash flows for participants. For example, we could offer a greater amount of the loan upfront to reduce the upfront cash needed to participate. And we want to maximize the likelihood that savings are realized for households to receive the financial benefits. We want to make sure that upgrades are selected that prioritize affordability and comfort if needed. We want to offer energy literacy and education to maximize potential savings and ensure that we're developing a reliable and trusted contractor network to ensure the work is really high quality. Late payments and defaults. We really want to make sure that we clearly define the customer journey for participants who have non or late payments. We want to make sure that participants and all stakeholders have visibility into this path and process of late and no payments and agree to the overall risk to participants in the program. We want to make sure that we're removing barriers. So designing programs to remove accessibility barriers such as trust, ensure they're culturally appropriate, community focused, and the communications are designed to educate, build awareness of the benefits of energy efficiency measures and include the role of the region in this. A lot of the clients really, a lot of stakeholders we talk to and our experience is that a lot of folks don't understand, why does the government want me to update my home? Why does the government want me to have new windows? What's the role here? And that really helps achieve some of the trust barriers that we see in communities. Renter protection. So considering how these projects might inadvertently impact the uptake of renovictions in the region. And that's when a landlord evicts a tenant by claiming they'll complete major renovations. So when we're designing the program, we really want to make sure that we're looking at tenant rights as part of the program design. And accountability. We want to develop KPIs and indicators to measure equity and impact of the program. So in conclusion, a few key messages. Certainly this was a fantastic project to be a part of, and we're so grateful and really enjoyed working with Reep and the other stakeholders. A few key messages to leave you with. One size does not fit all, and financing programs should not try to be low-income programs. Most jurisdictions, except Alberta, offer upgrade programs for lower income families. For households that can't afford financing, we should really be flag posting those households to these lower income programs. We can consider expanding and enhancing these programs to achieve our GHG goals. Default rate does not measure negative financial impact to participants. It measures the risks to lenders. We want to consider additional KPIs to measure whether a household is negatively impacted financially. The devil is in the details with program design. We want strong program design that's based on good learning, good lending approaches that ensures we accept appropriate participants in the program. This can mitigate the potential negative impact to participants and the reputational political risk to stakeholders. Now I also encourage you all to download the report that has lots more information, and all the information I shared with you today. There's a QR code right there that you can use with your phone. It's also on our website at empowerme.ca/energy-poverty. Now I'm going to pass to Stephanie to talk about Alberta and how the lack of low-income programming here may prove to create additional risk for financing programs, and how Alberta Ecotrust Foundation and Empower Me aim to fill that gap.
Thanks, Yasmin. Thanks, Mary Jane. Certainly lots of food for thought as we look to apply these learnings to financing programs, as we're seeing them all out across Canada. So just shifting us to the Alberta context and looking at our current landscape with respect to energy efficiency programming. So many likely heard over the past winter, many households faced utility bills that were higher than they had anticipated or had the capacity to pay. So as a result, the government of Alberta is providing $300 in relief for nearly 2 million households, in addition to an abatement on the fuel gasoline tax and a natural gas rebate. Now, while this relief will be welcomed by many, it is coming after the impact on households' budgets. And not to be too critical, but Alberta has had a historic tendency to bring in programs that provide rebates in a retroactive manner, rather than being proactive in supporting those struggling to pay their energy bills, even in more stable times. Additionally, a blanket approach that provides relief to all households, including those that might have more capacity to weather storms, does not focus on those in extreme circumstances. So a more targeted approach could be made to make meaningful change for those most in need. Next slide, please. So looking at the need in Alberta, about 1 in 5 households are living in energy poverty, and we consider families spending double the national average of their percentage of their income on energy bills to be in energy poverty. Now, there are existing rebate programs for homeowners in the city of Edmonton and federally through the Canada Cleaner House program, but these programs require homeowners to cover the upfront cost of renovations, which is often out of reach for many low and middle income households. And as we just spent the last half an hour learning from the findings with the Waterloo Region project, financing programs just really aren't a good one-fit-all approach for all households and are not suitable for low-income households. So in Alberta, we currently have a gap in programming to help those most in need when it comes to energy affordability. Next slide, please. So Empower Me and Alberta Ecotrust Foundation are partnering to fill this gap and deliver an energy poverty reduction and home upgrades program to make energy costs more affordable for households experiencing energy poverty in the cities of Calgary and Edmonton. And we're really fortunate to have the city of Edmonton, the city of Calgary, and NMAX see the importance of addressing this issue and have come on board as the initial funders and supporters of this initiative. Next slide. Before I get into the program details, I just wanted to give you a really quick overview of Alberta Ecotrust and our Climate Innovation Fund and our approach to working on urban emissions reductions in Alberta. Next slide. So Alberta Ecotrust Foundation is a member of Low Carbon Cities Canada, or LC3, and this is a partnership between 7 local centres and the Federation of Canadian Municipalities. So LC3 centres help city regions to reach their full emissions reduction potential, while at the same time unlocking benefits for local communities. So our Climate Innovation Fund was established by a $40 million endowment from the Government of Canada, and we identify, invest in, and scale up solutions covering a broad range of climate positive interventions in support of Calgary and Edmonton's climate plans. Next slide. So our programmatic approach really aims to solve multiple issues simultaneously and maximize co-benefits for our communities through the lenses of emissions reductions, scaling up solutions, co-benefits for communities, and social equity. We support projects and organizations in alignment with the climate action plans in Calgary and Edmonton by focusing on 3 key areas of emissions reductions, and those are buildings, transportation, and decarbonization and renewable energy. Next slide. So getting into our energy poverty and home upgrades program, Alberta Ecotrust and Empower Me aims to reach 100 or more households in Calgary and Edmonton respectively. Our intention is to address energy affordability, but also improve health and safety in the homes we upgrade while reducing carbon emissions. We'll build on previous work done by Empower Me to develop and design a program that can be implemented and sustained in the long term. And communicating our research and findings will also be important in raising awareness and support for addressing energy poverty in Alberta across all jurisdictions. Next slide. Our proposed approach will engage those most in need, including newcomers, immigrants, Indigenous communities, and single parents. As part of the program, energy literacy and education will be delivered to residents across both cities in multiple languages, helping them to understand how behavior can impact energy use in their homes. Our approach ensures that we are customizing the energy efficiency solutions for each home, and we'll also be working on incorporating current rebate programs to maximize the program budget and test approaches to utilizing conventional programs to address low-income household energy poverty. Next slide. So as Yasmin alluded to, it's important to have equity kind of at the key of any of these programs. So with our approach, we'll be delivering fully subsidized energy retrofits and making space in our budget to address health and safety upgrades needed in the homes, such as mold remediation, electrical work, and other basic upgrades that are sometimes needed before deep energy retrofits can even occur. As we will be bundling purchases and purchasing materials in bulk, we'll be able to maximize the upgrade potential in each home. And finally, our program will incorporate processes to allow renters to benefit as well. Next slide. So this program will impact and benefit vulnerable families through safer, more comfortable and affordable homes and reduce greenhouse gas emissions in homes unlikely to receive upgrades in any other way. Measures installed in each home will be selected based on the needs of the home individually and will be optimized to reduce bills over the budget of the program. In this way, we install the upgrades the home needs most to optimize affordability and greenhouse gas reduction. The program is not constrained by predetermined measures in a way that may or may not be appropriate for the home. We're also using this approach and opportunity to learn and develop recommendations that can be leveraged to catalyze longer term programs, both by the cities, but then beyond other jurisdictions. Last slide, there we go. So we've been able to jumpstart our fundraising efforts for this initiative through the support of the City of Edmonton, the City of Calgary, and Max, and a contribution from the Climate Innovation Fund. We would also like to thank other various program supporters, including Energy Futures Lab, Alberta Energy Efficiency Alliance, Fortis Alberta, Alberta Real Estate Foundation, and Efficiency Canada. And we invite any organizations that believe in the cause of reducing energy poverty in Alberta to join our coalition of funders. We are about halfway to our fundraising targets and are really looking for additional support from our community to make this program a reality. So that brings us to the end of our presentation. So thank you all for giving this time today to learn about this important and timely topic. And I think we have a number of questions that have popped up in the chat and Q&A. We're also put up our contact information there for all three of the presenters today, if you'd like to follow up on anything you've heard. So I'm just going to jump into the chat here.
Stephanie, would you like me to facilitate the questions for you?
Sure, yeah. Mike, you've been monitoring, so please feel free to take it from here.
Yeah, we know we've got some really great questions from the participants here. One thing is around, I think, the current approach to financing programs, and across the country, this is generally the case in that we've constrained the capital associated with them. So there are really limited spots for these financing programs, and generally they do quickly get oversubscribed. So one of the questions was, is that also a potential barrier? Like, is that something that sort of a signal to the rest of the market? You know, it's almost the financially fortunate and the ready to push the trigger people are the ones who get involved in these programs. Just maybe some commentary on that for the panelists.
I can provide some. Mike, I bet you have some thoughts too. I'd love to hear yours. Yeah, I think that's a really good point that, you know, when programs get filled really quickly, there's an equity aspect of that. You know, are we giving all households an equal opportunity to participate, or is it a certain few that, you know, are privileged in many different ways that are able to access that? I think that's a really good point. Yeah, Mike, I don't know if you have any other thoughts.
Well, I think that's part of what we're talking about today too, is that perhaps those programs are not the same programs that would be accessed by qualifying income households. We need to give thought about that. The other thing I think is very topical for Alberta here is the PACE programs. So do PACE programs eliminate or reduce the loan risk issue? And I think that's, Yasmin, you were talking about that from the municipalities' perspective. It's very different from the household's perspective. So maybe if you could just.
Yeah, I mean, I think the risks for households are around repaying the loan. And so whether that's a PACE or whether it's tied to utility bills or other formats, it's around cash flow, and it's around, we can reduce the risk by ensuring that we have program processes in place to ensure that only folks who can repay those loans are accepted. I think one of the pieces for a PACE program is the risk is greater when it's tied to the property. What are the cascading things that happen if I don't pay my loan back? If I don't pay my loan back for 2 years, am I going to lose my house? You know, the risk is a bit greater, I think, for when it's tied to the property, and people are less likely to a default or be late for those payments, which is great for the lender. You know, you're definitely getting your money back. But what is happening in that household to make sure that they can pay those loans back?
Yeah, thank you. Another question is integration of energy performance ratings or energy labeling, mandatory disclosure in various ways, either through the real estate process or not. I don't know, maybe Mary Jane, if you had a comment on that, if Reep has ever thought about combining these financing programs and with residential labeling, and maybe comments on, does residential labeling also disadvantage low-income households?
Yeah, there's certainly been interest in Ontario from many different fronts in providing a label for a home at the time of sale as consumer protection. And it's something we've advocated for. It was built into the energy plan, the I forget the exact name of it, but the climate action plan for the previous provincial government included this, but did not get to the point of enacting it. And it is not popular with real estate sector, and that they have been successful in keeping it from becoming enacted. It is something that I think some municipalities are wondering how far they can go on that front. We're not there yet in Waterloo Region, but we do see it as a really useful way of having people start to think about that aspect of their home, and in particular about the operating costs of their home when they're buying a home. So I would say that's not an issue that is dead. It's alive and well. And I don't know, I'm curious about whether it's come up in Alberta.
Mhm. Well, I'm excited to say that Alberta Ecotrust is actually facilitating a project thanks to the Alberta Real Estate Foundation's funding and our partner LightSpark to label every single family home in Calgary and Edmonton with a digital label. And this is definitely going to test the market. It's a bit of a disruptive technology. I'm really looking forward to launching it and seeing the impact of that particular approach in the residential market. But it does come up in Alberta a lot. Both of the cities have it in their climate plans being important. And certainly I think it's a piece of the picture when it comes to transforming our residential building stock. There's a question here about, it's more like a statement, but I'm wondering if it's relevant here about rental displacement, I guess, as you know, there's a term for it, probably someone will know it better than me, but when you actually retrofit the building stock, you displace renters that can no longer afford increased rents and that type of thing. Apparently in Alberta, there's particularly weak renter laws. Is there mechanisms that can be utilized to ensure that that doesn't happen or to mitigate some of that anyone's aware of?
Yeah, I think renovictions is the term that's sort of colloquially used. I think it really takes looking at renter rights in the region to understand what aspects of the home could happen when there's a renovation that could displace folks. So for instance, if a renovation is happening where the tenant cannot live in the building, often that's a way for the landlord to say, you can't live here, you know, we have to do these renovations, you're going to have to move. If the upgrades as part of the programming can be sure that, you know, they're not lengthy. So, you know, most energy saving measures, whether it's a furnace, windows, insulation, you know, those are 1 day, maybe 2 to 3 day jobs. They shouldn't really displace renters. So making sure that you're having program processes in place to do that. We've also talked to Reep and the other consultants about making sure that we're communicating both to the landlord and the renter what their rights are, and saying the same things to both the renter and the landlord so that everybody is on the same page of what these renovations mean and that the renters cannot be displaced, I think is an important piece. But I know our friends at Efficiency Canada are going to be looking at this. I think it's certainly the nut of renters is a big one across the country, and not just low income. You know, in lots of markets, renters are not low income.
Right. Stephanie, I think it's a pretty straightforward question, but what is the proposed or forecasted budget for the energy poverty program right now?
Yeah, so our budget is about 1.2 million per city, so that would be 100 households in each of the cities. And this is a holistic budget. So this includes upgrades, the retrofits, the education and outreach that will be occurring as a result of recruiting and getting in touch with residents, as well as all of our recommendations and research that will go into our reports and sharing our results in the end as well.
Mm-hmm. And just to add to that, I saw a question about expanding outside of Calgary and Edmonton. And so certainly our intention here is to build a program that can be expanded across Alberta. The need is across the province, and we want to create a sustainable province-wide long-term solution for lower income households in the province so that financing programs are not the only thing in the market, that we have other solutions for these households that work, that address affordability, that address climate goals, that address energy efficiency. You know, it really is a multi-solving approach.
Yeah, this one, next question is more, I guess, commentary on, I guess, we can't speak for municipalities. We don't work for municipalities, but do we get the impression that municipalities really understand the scale and magnitude of this challenge, given the programs that are launched? And there's the energy poverty side of it, but there's also just the scale of the retrofits that are required. So anyone want to comment? Maybe Mary Jane, I mean, you work very closely with the municipality. Is that clearly articulated that, you know, I know it, for instance, in Edmonton and Calgary, the modeling is suggesting, you know, it's nearly 20,000 residential dwellings per year need to be renovated to a pretty high energy performance standard by mid-century.
I think that this is kind of the first effort in bringing this to the attention of our municipalities in the language of energy poverty. I do think that our municipalities are very aware of the housing crisis and affordable housing, and that is what they're hearing on every doorstep and in the papers and from everyone that speaks to them. So that is very much on the radar here. And there's a lot of different efforts underway with nonprofits to build more affordable housing. And what we want to do is bring in this knowledge that part of it is making existing housing more affordable and add that to the picture. So I am not sure that is parsed out in that way that much yet here, and we're hoping to bring that to the table. But it certainly was our municipalities all around the table as we presented this research that they were part of helping to support. So we're on our way there.
I think just to add to that, I think the challenge is that for municipalities, the challenge is that historically, energy efficiency programming for lower income families have sat with utilities and also provincial governments. And so they are, you know, to Mary Jane's point, there's the housing crisis, but including energy efficiency and home upgrades and climate goals, there's a bit of a gap there in terms of historic program delivery, I guess I would say. In Alberta, I think it's, you know, it's even more stark. Alberta is the last province or state, actually, if we include the US, to have a lower income upgrades program. So certainly the need is so much greater in Alberta, and we don't have a program here yet.
You know, some of the things you talked about in your presentation, Yasmin, were really geared towards underwriting criteria, you know, a test of means to pay. And one of the things you recommended was the debt to service ratio. And many of the municipalities are running these programs, though. Is that an easily accessible thing for a municipality to obtain?
Well, I think it's just, if you're going to loan money to folks, you need to ask the right questions and understand their affordability challenges. You know, what's your income? What are your loan payments? What's your car payment? How much money are you paying for childcare? You know, can you afford this $200 a month? I agree, it's not easy information to access, but, you know, if I go to the bank and I ask for a loan, they're going to be asking me those questions. And I think consumers are more likely to answer those questions when they're receiving money as a loan. So I think it is a bit of a challenge for municipalities who are, you know, they're not banks, but if we're going to be lending money to folks, we need to understand the affordability of participants, because the risk is just too great. You know, we, as a municipality, we don't want to be putting folks in worse positions than they started.
You know, there's a bit of a knock-on question here. Just, are there other KPIs? I think one of the participants here is saying, you know, we're sort of using low income interchangeably with those who are impacted by energy poverty or feeling energy poverty or in energy poverty. Are there some KPIs beyond what you've talked about that we could understand or pose when we're creating underwriting procedures to understand some of those nuances, other than debt to service ratio?
Yeah, I think there definitely are. I don't have an answer off the top of my head, but I think we would look at demographics, geographics, housing types, equity-based KPIs need to expand across those pieces. I totally agree around, lower income and energy poverty. Those are overlapping, but they're not the same. Yeah, maybe not enough time today to get into it.
Yeah, like, I mean, there is that interesting work that Empower Me did a few years back now that, suggested that just because you might actually be in a middle income bracket, it doesn't mean that you're not experiencing energy poverty.
Absolutely, yeah.
Depends on the situation that you're in. So it also goes the other way. It's not just, your low income or qualifying income, and you may not be in energy poverty, but you can also be of higher income and be experiencing energy poverty.
Absolutely, yeah.
Okay, well, we have a few minutes left. There's still quite a few questions here, and definitely lots of interest in the constrained housing supply and how these programs might sort of dance with those. There's been lots of media attention on the fact that we are really underbuilt in Canada. So the affordability of homes is challenging right now. How does this sort of idea of focusing on energy poverty and retrofitting the building stock as we know it can sort of address some of those other challenges, those greater sort of macroeconomic challenges of limited and constrained housing supply? Any thoughts on that? It's a more complex question, but
I'm going to pass it. Stephanie. MJ?
Well, I think if I understand your question right, Mike, what I'm hearing a lot about in our community is build, 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 and not just our community, our province, our country. And I think what you're getting at is we should not overlook the built environment that's already here and the potential, the embodied carbon already in those buildings. They're the lowest carbon building we're going to be able to work with right now because it's already embedded there. And we want to make those buildings that are part of our streetscapes and our history and heritage viable into the future. And doing that addresses a lot of different concerns and issues in the community, including affordability and neighborhoods, building community and neighborhoods that last. And I don't know, am I getting at the kind of thing you were looking for, Mike?
Well, I think that's what, this was a question posed in the Q&A, and it's definitely, I think, what you're getting at. Some, attention on basically building out what we already have. And, there's also, we've overbuilt post-COVID now in the commercial building sector, potentially, right? In the office buildings, is there building adaptive buildings that can be used for affordable housing to also address this lack of housing, that kind of thing. So just being, aware of ways to increase our housing supply without building out to greenfields.
Yeah. Mike, could we address a couple of the last questions? I think there's a point coming up here that's important to say, which is what we're understanding from this research is that there will be some households that don't have the financial wherewithal to participate in a loan program but that will really benefit from energy efficiency upgrades. And we need programs to address those households where there is no cost for the upgrade. So I'm saying yes to you, John Clark. Can energy upgrades be free? We need a national low-income energy efficiency program. And we need to, it's a bit patchy in different provinces that have it right now. And I think there's people being missed by some of the criteria that also need help making upgrades. And so I think that's kind of one of the biggest findings is that there's going to be gaps. There's going to be people that can't participate in the program that really need to have energy savings and dollar savings and more comfortable functional homes. And we need to ask ourselves, how are we going to provide those energy upgrades for those people?
Well said. Yeah, I think that's a good point maybe to just move to closing out the session. I don't know if that's Stephanie or Yasmin would like to do that.
Yeah, I can jump in. Thank you, everybody. Certainly, we had an overwhelming response to this webinar, which is wonderful and amazing, and really just shows the need across our country as financing programs roll out. We certainly want to make sure that folks are not being negatively affected by financing programs, but we also want financing programs to be successful. They have a strong place in achieving our goals. We don't want people to suffer because they're part of it when they shouldn't be. Please reach out to any of us if you have any questions. It's always a pleasure to speak to all of you and speak to like-minded people. Thank you to MJ and Stephanie. Always great to be on a panel with you both. And that's it. Thank you. Have a great day.
Thanks, everyone. And a big thanks
everyone.
to the FCM for funding this research. Bye all.